So to start things off, let's talk about what is a shelf. This is your higher time frame order block. So in this case, this is your macro order block. But how this macro order block would look on a lower time frame is like this. It would be represented in a shelf. So it's your swing low and swing high the trap price prior to the break, which usually on the micro looks like this, and on the macro that would be your macro order block. So let's look at this example of a shelf. So you have a break of structure, and understand something forced price to break structure and continue the bullish trend. This would be your zone, and understand that price could come back inside of the zone and reverse from multiple areas. Could reverse from here, here, here. Why? Because there are orders right here. So let's take a look at this example. You can see you have a break of structure. So you will mark up your last high and your last low, and this would be your shelf. So now inside of the shelf, you need to locate your order blocks. You have one order block here, another order block here, and another order block here. And as we proceed in this lesson, we're going to figure out how to pick the perfect order block. And not only that, how to combine it with inducement. As you can see, inducement is getting engineered and price breaks down. It's your order block and expands. So as we proceed in this lesson, our main goal is to figure out how to pick the exact order block. And if you have any clues at this early stage of this lesson, let us know in the comments. A lot of seasoned traders will know the answer early. So first thing you want to do is you want to locate your shelf. So what do we have here? We have this low, this high, and this swing low. This is what trap price prior to the breakout. So this would be our shelf. So what is our next step? Our next step is to locate the order blocks. So what do we have here? We have an order block right here. And we have another order block right here. So now if I ask you, which one would you choose? Would you choose one or two? So the first thing you want to look at when picking your order block inside of a shelf is that you want to look for a order block with the strongest reaction. So let's zoom in, really dissect this. So if you look at the reaction from this order block, is just these two candles. This was your reaction. And now if you look at the reaction from this order block, this was the reaction which forced this break of structure. Which forced this break of structure that initially formed your shelf. So based off reactions, my pick will be the first order block. So that's based off the reaction. Now, if you look at this order block right here, let's zoom in. What disqualifies this order block? I'll give you a few. So what disqualifies this order block is that it's been mitigated. As you can see, price formed your order block, broke structure, came back down and already used this order block. This is the definition of mitigation. So this order block's already been mitigated. So this disqualifies this order block. So now what we have is a pro for this order block and we have a con for this order block. So by understanding that, you would simply get rid of this order block, and now this order block is your target. And obviously, you would want to combine your macro timeframes. As you can see, you had a macro break of structure, prices in a P2 of a supply and demand structure. So you are anticipating a retracement back into your shelf. Before you proceed, please make sure you like the video and leave a comment. And if you're interested in joining our Discord, make sure you reserve your spot because spots are limited. So now that we went over the first portion of this lesson, let's have a quick quiz. So the first thing you need to do is you want to locate your shelf. In case you took too long, this is your shelf. So now what is your next step? Your next step is to locate your valid and invalid order blocks. And even after you locate your valid order blocks, you need to locate the order block you're going to choose. So the highest probability order block here is this order block. Why? Because basically your reaction, the reaction the order block gave you. So now what is your second valid order block that you're probably not going to use because you already have your valid order block? It will be this order block. So now, where's your invalid order block? This would be your invalid order block. Why is it invalid? Because this order block was already mitigated. So let's talk about inducement. So let's say you have a break of structure. First thing you want to do is you want to locate your extreme order block. So your extreme order block would be somewhere down here. And your next step is just how I explained in all my previous lessons. You always want to pull out your fib and you want to locate your levels. You want to locate your extreme levels. This would be your extreme discount and this would be your extreme premium. So you would want your inducement to occur in fair price, somewhere in the middle. At fair price or before. So what you would see here is price will come down, maybe consolidate, break structure, induce traders into taking a long position because we know majority of the traders, especially in Forex, majority of the traders in the market are scalpers. So they're mostly targeting your 10 to 15 minute traders, 1 minute traders. So a fake setup will appear right here. A lot of uninformed traders will try to get in a trade right here just for price to come down to the initial point of interest and continue the trend, which is obviously your supply and demand structure in this case. So the first thing you do is you pull out your fib and you mark your low and your high. And like we said previously, you would want your inducement to be engineered at your fair price or before your fair price. So you would expect liquidity to be engineered right here to induce traders into taking a long position. So basically, it's a fake out price starts consolidating and all the scalping traders are looking for a stop hunt or are looking for a continuation trade right here. Why? Because price is slowing down. And if you look at it from a macro perspective, price is bullish. So the purpose of the inducement is to induce traders into taking a long position. So what is happening here? Traders are being induced into taking a long position. All these rejections. You can see price is rejecting here, rejecting here, rejecting here, rejecting here. And even if you look at it from a lower perspective, there are minor traps being set. As you can see, price formed your low, formed your high, came back down, reacted of your order block on the micro time frame. So let's go even lower. Let's delete this real quick. Look at the amount of times the market is trying to induce traders into taking a bullish order block. Price reacted from a bullish order block right here, even broke structure. Price reacted of this order block, broke structure, and came back down inside of another order block. So the market is trying to induce traders into taking a long position. After this break of structure, this would be a lot of beginner smart money entry. And they would try and take a long position here. Price retraced again. They would try and take another long position here or wait for a stop hunt and another micro break of structure to take another long position. So these are all traps. An inducement is a sequence of traps. So now let's go back to our operating time frame. And let's mark our fib again. Where is our order block? Our order block is our order block in our discount level, in our extreme discount. And this is your liquidity being engineered at fair price. You can see price is rejecting at fair price. Sometimes your liquidity can be built right here. So now let's remove our fib for a better view. And price used our extreme order block to shoot up. And look at what happened here. Price rejected, broke structures on the micro, and even price came here and rejected again. So let's take a look at this example. First thing you want to do is you want to mark out your shelf. So what is our shelf? This would be our shelf. And after marking our shelf, let's locate our order block. So in this case, our order block obviously would be this bearish order block. And what validates this bearish order block? Simple, the reaction. And not only that, it's really the only order block in this shelf. So the first clue is it's the only order block in this shelf. And the second clue is just look at the reaction that forced the breakaway. This was the reaction. So now what do we do next? You pull out your fib, mark your levels, and understand where price is. Obviously, the order block is in our extreme premium zone, and price is right now coming back from our extreme discount zone. So let's mark our fair price. And now let's look at what happened previously. Price broke structure to the downside in a micro structure. So now we're currently on the 2-hour time frame. Let's drop down to the 30 minutes and let's see what happened. Remember guys, the inducement must be at fair price or below. So this is valid as far as an inducement. So look at what happened here. Price broke structure on the micro levels. I'll zoom in, just give me 1 second. Let's look at what happened here from a scalper perspective. Price broke structure. Not only that price broke structure now, a lot of supply and demand traders and smart money traders will be looking at an entry right here. So this is your inducement. So a lot of traders would be looking at an entry here. Why would they be looking at an entry here? Because looking at the overall trend of the market, it's bearish. So it makes sense for a lot of beginner traders to take a sell right here at this supply level. But we know that this is the initial point of interest. And if you go back to our operating time frame, you'll see price takes out all these traders that wanted to sell the market, and price goes directly to our point of interest.